From New York City, for our viewers worldwide, I'm Taylor Briggs in for Jonathan Farrow. Bloomberg Real Yield starts right now. Coming up, Fed Chair Jay Powell pushing back against a pivot, signaling higher interest rates, all to stamp out inflation. And it is sending stocks much lower and magnifying that inverted yield curve. But at first, we begin with the big issue. Chair Powell taking center stage in Wyoming.
Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done.
Joining us now, JP Morgan's Kelsey Barrow, Morgan Stanley's Matt Hornbach, and of course, Jim Bianco of Bianco Research. Jim, let me start with you. I know that we're always focused here on the rates markets, but I'm looking at an equity market that appears to be caught off guard. What did you glean from Powell today?
Yeah, he basically undid the mistake that he made on July 27th at his press conference. Then he said that the Fed was broadly close to neutral and that they would abandon forward guidance. And the market took that as a signal that the Fed was going to pivot, that they were eventually going to raise rates a couple more times, stop, and start cutting rates in 2023, launching the big rally that we've seen over the last several weeks. I think what he did was he pulled that back today. He said that wherever we're going to go, we're going to stay the course. So maybe they raise rates 75 basis points more. Maybe they raise rates 200 basis points more. We could debate that. But then they're going to stand and hold on that for a long period of time. In other words, no pivot. And the market, I think, was taken aback that the Fed is not going to be as accommodative as they thought maybe even 48 hours ago.
Matt, do you agree? Is this a market that is sort of getting new signals, new clarity, new guidance today? Or was this speech as expected, a hawkish Fed that's coming out full in front?
Well, I think that investors were sniffing this out a little bit over the past week. And so I don't think this was a total shocker for investors that are paying attention. But I do think that there were definitely some more hawkish elements to this speech. I mean, at the end of the day, these were remarks that he wanted to give. There was no Q&A session. There was no opportunity for him to be pulled off course. This was a very intentional message, really playing up the underlying strength of the U.S. economy and playing down the miss after the last CPI report. So this was a very intentional message, and I think it went off really well. I think he did a great job.
Kelsey, how are you thinking about a hawkish Fed today, firmly full steam ahead, and very here focused on inflation?
Yeah, we agree. Chair Powell's speech we would view as generally very successful. So going into the speech, what I was looking for was for the market pricing for September to remain around 50-50 probability, half the percent on 50 basis points, half the probability on 75 basis points. And where the Fed, Chair Powell needed to push back was on the idea that there'd be rate cuts in 2023. And I think he successfully did that. You know, one of the other observations that I'd note, right now, the focus really still is on inflation. I counted the number of times he said inflation. It was 47 compared to just 6 times he mentioned employment or labor. It shows where his mind is at. And we think that that is very appropriate. And the reaction in the bond market, the curve flattener, I should say, higher front end yields and lower long end yields is a reflection of the Fed's continued resolution towards this outcome.
So, Jim, at the top of the program, you said that we could debate this if we want. So let's do it. Let's debate it. It's interesting. Bank of America is saying the bond yields, they actually still haven't peaked. Adding, quote, a hawkish Fed is bullish. A dovish Fed is bearish. Rates are too low. QT too light, with inflation unlikely to fall below 4% by 2024. Thus, Fed funds likely need to be exceeding 4% by 2024. The sooner the Fed plays the role of the courageous lion, the better for macro, the better for markets. How are you thinking about a 4% Fed funds rate and the path to that?
Yeah, I broadly agree with that, yields have probably going to have to go higher, especially on the front end. I mean, the 2-year yield is just a couple of basis points away from a new high for the year. And that seems like it's almost a layup that that's going to happen. But I think really stepping back from all of this, really, what's the problem with inflation? Why do we have 8.5% inflation? Is it a one-off reason because of the post-pandemic reopening? The Fed raises rates, squashes demand, inflation goes back to 2% and stays there for the next generation? Or is this an era of more persistent inflation? That's where I am. If so, the Fed is not going to stop at 2.5 or 3 or 3.5. They're going to probably take their argument of that they have to go 50 basis points above the inflation rate or 50 basis points real. And if the inflation rate settles down around 4, 4.5, 5, they've got a lot more work to do. So it really comes down to where do you think the secular movement in inflation is? Something, by the way, Chairman Powell has not addressed. He always talks about these short-term things, pulling back the pivot, what we're going to do at the next meeting. But now, where's the inflation rate going to be in 5 years? And assuming here is that he thinks nothing has changed in the last couple of years. We're just going to go back to 2, and that's going to be the end of it.
Matt, curious how you weigh in here on the path to what a terminal rate Fed funds look like when we get there, and really to Jay Powell's comments this morning, how long we stay there.
Yeah, Taylor, I think that our economists see the Fed funds rate peaking just shy of 4%. But look, I mean, it's a very uncertain outlook. And I think that the risk around that forecast is for, even higher short-term interest rates. That makes complete sense to me. So, in terms of the path, it was pretty clear that the Fed's not done front-loading. I didn't get the sense that they were ready to pull back on the pace of tightening necessarily. Obviously, they need to see more data. They don't know exactly what the next payroll number will show or the next CPI report or next retail sales numbers will show. But it's pretty clear that they aren't there yet. They're not ready, I think, to pull back. And so, we could get there relatively quickly still, I think.
Kelsey, curious how you fold in not only the Fed funds rate, but also QT. It's not lost on me about a week from now when we're in September. We're looking at ramping up QT 60, 65 to maybe 95 billion a month in terms of a roll-off. When you think about peak QT, how much heavy lifting is that doing in order to tighten some of these financial conditions?
Yeah, that's a great observation. And also, I would note, if you look through Chair Powell's speech, there is no discussion of the balance sheet. There is no discussion of quantitative tightening. And I admit, if you're channeling your inner Volcker, and that's, I think, what Chair Powell was looking to do, Volcker didn't have to deal with a very large balance sheet. Obviously, today, we're in a very different situation. But I do think that we need to be sensitive to the fact that the balance sheet runoff is going to be stepping up. They are withdrawing liquidity. And more broadly, I think the challenge, particularly for risk assets and for credit spreads, is the fact that this is not just going on in the U.S. This drain in liquidity is going on globally. And what we saw over the last week, really the showstopper was not the U.S. It was what was going on in Europe and going on in the U.K., where they're really looking to ramp up their response function as well. The 2-year gilt yield is, I think, 110 basis points higher than it was at the start of the month.
Jim, just quickly weigh in here. When you think about Fed officials talking about hiking at the expense of a labor market that's strong, but there might be some pain if inflation is first and foremost. What does labor market pain look like to you in order to tackle inflation?
Well, it would look like higher. It would look like higher unemployment. It would look like lower employment. And by and large, we don't have that right now. Just remember, too, I think the Fed is right. Inflation afflicts 100% of the population. Unemployment, if you were to get it, would inflict a small percentage of the population. Badly, but a small percentage. So they're looking at inflation as being a scourge for every single person. They can't ignore that because the employment statistics weaken for a few months or so. So I think they've got the right approach in this. It's just their communication and trying to get this across to the market. Here we are in late August, and they're still trying to convince the market of this when they started raising rates 6 months ago.
Really appreciate it. Kelsey Barrow, Matt Hornbach, of course, Jim Bianco, everyone going to be sticking with me because up next, the auction block. Primary markets stuck in a little bit of a summer lull, remaining on hold for Jackson Hole. That conversation coming up next. This is Bloomberg. This is Bloomberg Real Yield. I'm Taylor Riggs, of course, in for Jonathan Farrow. Time now for the auction block. We're going to be kicking things off in Europe. Now, of course, with the summer slowdown starting to fade a bit, issuers across all sectors staging a comeback, pushing weekly sales above 30 billion euros. Back here in the U.S., high-grade bond sales ending a pretty busy month on a quiet note. August issuance topping $110 billion, even with just 3 small deals this week. And of course, we go to one of my favorites, the junk bond market. Those issuance actually expected to remain closed through the month. No new debt sales this week, really after pricing more than $8 billion earlier in August. And I want to stick with credit. JP Morgan's Bob Michael warning investors that bond markets, they're still mispriced. Take a listen.
I'm looking now at credit spreads in the mid 400s, and they just look too expensive to me. They don't seem to adequately price in recession risk. I think we, by year end, are certainly going to go back up to the old highs of around 600 over. I also don't think that the market is adequately pricing in quantitative tightening. I want to see a couple months of that and see what the appetite for the market to digest bonds when they're coming out of the Fed left, right, and center.
Kelsey Barrow, Matt Hornbach, of course, Jim Bianco still back with us. Kelsey, it's interesting that Bob Michael folds in some issues within high yield and also mentions QT, really folding over the nice conversation we were just having into this segment as well. How are you thinking about the lack of spread widening all as we approach QT and a high yield market that's actually signaling to the equity market things may not be that bad?
Yeah, so what we're thinking here is spreads in that 400 range is not appropriately compensating you for the risk of a recession or hard landing. Back earlier in the summer, spreads got as wide as around 600, 650. At that point, we said, okay, there's a bit of cushion in there for rising defaults, which are going to start picking up even just a little bit just because of how low they started at. And so now what we're seeing today, I think, is a very healthy reaction to Chair Powell's speech. Credit spreads are wider. And we think that the pressure on credit spreads will likely continue as we head into the fall.
Matt, what are high yield credit spreads at 450, 480-ish, clearly sub 500, signaling to you?
Well, Taylor, I think the difficult part about quantitative tightening is we know what investors will have to buy. They're going to have to buy more treasuries. What we don't know is what will they have to sell in order to raise the cash to buy those new treasuries. And I think that is where it's challenging for the risk asset complex in general to understand what the effect will be of quantitative tightening. We know what it will be in the treasury market, which is why the treasury market has by and large priced it in already. But all the risk assets like these high yield bonds, we just don't know who will sell them, when they will sell them, at what price they will get sold. But something will have to be sold. And I think that is where quantitative tightening can have an additional negative impact on risk assets, apart from just the Fed continuing to raise rates extraordinarily quickly.
Matt, just a quick follow on that. You mentioned treasuries, but what about MBS? They're the largest buyer of MBS, a heavy hand. When they take their foot off, what does that mean for the MBS market as well?
Well, this is where it gets really interesting, because for agency mortgages, again, we know that more mortgages might come to the market if the Fed's no longer buying them. But we also have to remember that rates are up quite a bit. And so the supply of mortgages is also going to be much lower. So for agency mortgages, it's a bit different. We don't know exactly what the supply will look like, other than it's probably going to be lower than what it was at lower rate levels. But we also know that the Fed will be buying less. So that's a more difficult game for the market to play. For treasuries, we kind of have a good sense. We have a sense of what the deficit will look like, and we have a sense for how the U.S. Treasury will finance that deficit in the absence of Fed support. So for agency mortgages, it's more difficult, but they've already repriced quite a bit, Taylor.
Jim, I'm taking a look here at a terminal chart, one of my favorites, investment grade spreads in cyan and high yield spreads, of course, in white. And we're showing the lack of widening, 446 basis points over treasuries. Within your balance sheet analysis, are these companies, given the record low financing rates that they've had, just in better shape, and that's why we don't see the spread widening? Or is this a market that's complacent?
No, I think it's actually a different composition. Remember that the high yield market has a bigger percentage of energy and industrial companies than, say, the stock market averages have. And those companies are benefiting from a perception that inflation is going to stick around, their prices are going to go up, especially at the energy sector. It's almost 13–14% of the high yield market, where it's only a couple of percent in the stock market. So they're benefiting from that. So, but don't mistake me. I do agree with Bob Michael that these markets are expensive and these yields have to go higher. It's just keep in mind who is a high yield borrower. Very little, racy technology growth kind of companies that are borrowing, if any, in the high yield market like you see in the stock market. So it's a very different composition. And finally, I agree with Matt, that there are no bad bonds. There's only bad prices. I could move you as many treasuries as you want. You may not like the price I have to move them at. And we're going to find out what price we're going to have to move that extra $60 billion a month of treasuries that the Fed used to buy that won't be buying starting next week.
Kelsey, I want to go duration and convexity. Many would argue that the good thing about high yield is it has a shorter modified duration relative to investment grade. And when yields are rising, you want that defensive nature, except that then you're in high yield and not investment grade. What does this new defensive nature mean to you?
Yeah, so we agree that you do want to maintain a defensive bias to duration, that yields in the front end can continue to rise. But how we've been playing this is we've been watching spreads rally. We've been using that opportunity to take down risk in high yield and then reallocate that to other areas that have those break-evens that you were mentioning, Taylor, those higher all-in yields with the lower duration that have a better spread cushion. So things like a short-dated investment grade or a securitized credit where you can get a single A auto ABS loan, for instance, with a 5% yield.
Kelsey Barrow, Matt Hornbach, Jim Bianco, of course, everyone still sticking with me, because still ahead, the final spread, the week ahead, featuring more Fed speak. You have a U.S. payrolls report, all those conversations coming up next. This is Bloomberg. This is Bloomberg Positive, real yields finally. I'm Taylor Riggs, and for Jonathan Farrow, of course, time now for the final spread. Really looking at the week ahead, right? Coming up, of course, the Fed in focus. Take a look at sort of all the Fed speak that we're going to be getting. Barkin, Williams, they're speaking earlier on in the week. We'll be getting consumer confidence, those numbers out in Europe and the U.S. on Tuesday. We'll get another read on European inflation Wednesday, and then, of course, ISM and initial jobless claims. Those come Thursday. Finally, the big data point of the week, another U.S. payrolls report, and that comes Friday. Kelsey Barrow, Matt Hornbach, of course, Jim Bianco still back with me. Matt, how important to you is another data point that is the U.S. payrolls?
Oh, it's very important, Taylor. I think it's probably the make or break between 75 and 50 personally. Obviously, the CPI report is also important, but the reality is that the underlying strength of the economy shows up in the payrolls numbers. And if the payroll number is strong again, what that's telling the Fed is that, they've got to really worry about underlying inflationary pressures through the Phillips curve framework. And that's something that I think will resonate with them and could very well make the difference between 50 and 75 in the market's eye as well.
Jim, are you looking at that payrolls as the difference between 50 or 75 in September?
Yeah, I agree with Matt. I mean, it's also a bad news is good news scenario. Remember now, 7 of the last 8 months, the payroll report has beaten the consensus. And last month, it beat the highest guess on the street. So if we continue to see that pattern of very strong payrolls, the market's going to price in 75 right away. So that is the bad news, or good news would be bad news for risk markets. And so that is upside down. But I do agree that that is going to be a make or break report. The Federal Reserve Chairman warned us that if we were to see a slowdown in payrolls, that they would not be deterred from hiking. We haven't even seen that yet. And so if we go another month without seeing it, we're that much further away.
That sort of kicks us off nicely into the rapid fire round. My first question for you, Kelsey, I'll start with you. 50 or 75 in September?
75.
Jim?
I'll go 75.
Matt?
The house call is 50 basis points.
Okay. Second question, of course, I want to pull up here. When I think about a rate cut in 2023, yes or no? Kelsey?
No.
Jim?
Emphatically no.
Matt?
I don't see it happening.
Okay, 3 for 3. And then finally here, do you get 350? Is that sort of the intermediate peak on the 10-year yield? Kelsey?
We can hit it, but that's the high for the year.
Jim?
I'd agree with that, and I think it might go higher in 24.
Matt?
I agree with Kelsey. I think 350 is probably the peak in the cycle, but we could get back there.
So much consensus. I love it. I vote 2 things. John should take off more often so I get to do the show. And 2, let's extend it to an hour. Because what a pleasure this was for me. Kelsey Barrow, Matt Hornbach, and of course, Jim Bianco. As we're always so focused as we are on Friday at 1 o'clock on real yields and nominal yields that really migrate higher here on the front end of that curve. We're also, though, focused on this equity market that seems to be taken a little bit surprised by Jay Powell's comments this morning. We're rolling over an S&P off 2.2% and NASDAQ, those big tech-heavy stocks, off 2.8, 2.9% as well. So you have an equity market on the move and a bond market firmly rethinking the path forward for this Federal Reserve. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.